Good afternoon, everyone. We see a few of you have already joined us. Thank you so much. We are ready to get started right at 2 o'clock, so we'll allow a few more people to join us, and then we'll hop back on. Thank you. Okay, we're right at 2 o'clock. I think we're going to just get started.
Sounds great.
With it.
Sounds like a good plan to me.
Okay, great. Welcome to the Collateral Eligibility webinar. We're so glad that you joined us this afternoon. We know that you're very busy, schedules, but we're super happy that you joined us.
We'd like to introduce ourselves. I'm Elaine Shoemaker. I'm the Financial Services Manager on the operations side. So what that really means is security safekeeping and any pledge release of collateral, that all goes through our department. I have been with the bank since 1987, so I was out of kindergarten when I started. Just kidding. Been here a very long time, getting ready to celebrate actually my 35th anniversary here at the bank. So
amazing.
Yeah.
Amazing. Okay, and I am Kylie Murgan. I'm the Director of Financial Services. I also started out of kindergarten. I'm just kidding.
Right.
I've been here about 15 years. I started actually as a collateral review analyst, is what we called them at the time. Now they're collateral review officers, but I performed on-site collateral verifications. That's what I did the first couple of years I worked here, and then I managed that team for quite a while. And then in 2017, we grouped Elaine's team and the collateral review folks all together. And so I oversee both sides of that, with collateral review and the verification process, collateral eligibility on that side, and then safekeeping and collateral operations.
All right. So today, we would like to, our goal is to provide you better insight into the Federal Home Loan Bank's method of how we establish our underwriting guidelines. We want you to learn more about the important changes and eligibility criteria that we've updated, and just really overall expand your knowledge of eligible collateral. So in order to achieve those goals, we're going to tell you why we have collateral guidelines. We'll go in detail about the recently approved changes that our board just approved on Friday, the 25th. Kylie's going to go over the schedule of eligible collateral in pretty great detail. It's going to go fast, and it's a lot of information. So we'll open it up for question and answer at the end. So please feel free to send us those questions.
Absolutely. A couple of housekeeping items. We do have the chat and Q&A function available for you. We are monitoring that throughout the webinar. So if you have something that pops up, a question that you have while we're discussing something, feel free to use those functions. You have been muted. That's just for everyone's enjoyment.
Right.
And then the other sort of overall comment is that most of what we're going to talk about today is for our blanket pledge members. So there are some specific underwriting guidelines that are different for our specific pledge members. And so today we're going to focus on our blanket pledge members because that is the majority of our membership. If you are a specific pledge member, certainly reach out and we can go over any of those differences.
Right. They're basically the same, just a little bit different.
Little tweaks here and there.
Yes, yes.
Okay, so what is eligible collateral? Essentially, it's those assets that are pledged by our members to secure your FHLBank credit obligations. They must comply with the established underwriting requirements that we publish in our Member Products and Services Guide, specifically the Schedule of Eligible Collateral, which Elaine said we're going to go over in very great detail.
Yes. Okay. So what types of assets are eligible to pledge to Federal Home Loan Bank? Cash is king.
We like cash.
We like cash. And FHLB Topeka issued CDs. We also take securities. They have to be held here in safekeeping with us or at an approved third-party custodian. In order to utilize a third-party custodian, we have a process. It has to be pre-approved, agreements in place before you can utilize that. So if there's ever any interest, just send us an email, and we'll get that process started for you. Loans, we like loans as well. 96% of our member base pledge loans via the QCD or the qualifying collateral determination form or through the delivery process, okay? All loans are owned by those institutions. Just an overall view of what we actually manage in collateral. Unpaid principal balance, total collateral, is over $129 billion in UPB, which then it turns around and is equivalent to $96.6 billion in lending value. Of that lending value base, we have over $84 billion in lending value on loans. I have a breakdown of what's held here in our vault, which is the 1,149. And as you can see, the majority are held at your institution and pledged to us via that QCD form. Securities over $12 billion in lending value, which supports a total credit obligations outstanding of just over $34 billion. So keeps us rather busy.
Yeah. That also shows that we've got about $60 billion in available collateral that we can lend to you guys. So feel free to do that too.
That's right.
So why do we have underwriting requirements? First and foremost, it is prudent risk management. I'm sure you all have loan policies, you have guidelines that you follow, we also have them. It allows us to adequately manage our risk to protect all of you, our stockholders. It also allows us to establish transparent guidelines for what is acceptable collateral. We try to make them as transparent as possible.
Yes.
We also try to hopefully guide you with a streamlined approach to identify those assets which can be pledged. And we like those assets to be homogeneous, that are marketable and that we can liquidate. We have to be able to, per our regulation, we have to be able to perfect our security interests in that asset, obtain a readily ascertainable value, that's a mouthful for me,
Right.
and then we need that asset to be able to be reliably discounted or priced, right? Can we send it out to market and get a price for it? And in the worst case scenario chance, could we liquidate that asset in due course?
Right. And have we ever had that liquidate?
No. Do we hope we ever have to?
No.
No.
Do
But,
we have to prove that we can?
yes. So per our regulation, we have to meet those requirements. And so under each asset class, we try to create groups. And we're looking for similar loan characteristics that allow us to group like loans together. We're looking for a similar perfection process, liquidation process, and any volatility components that they may have. We also look for common troublesome loan characteristics like, high loan to values, DSCRs, debt service coverage ratios, credit issues, those types of things. So certainly some of those come from requirements that our regulator have put forth, but some of that, again, is just prudent risk management.
Right. Right. So you may ask, how do we establish our lending value? So at least annually, we go through this big process. We look at all of our asset categories individually, and each by asset category, we break it into three components, right? So your credit factor, what that is we look at the asset quality of each of our asset groups, and by evaluating the historical performance of those loans or securities during a 9-year look back. We also look forward at the delinquency tendencies in our 4-state area. So we start off at 100%. We take off for the credit factor. We go down to the volatility factor. That's really a 12-month look back in the movement in price of those particular assets, right? So what's the volatility in the price? So we're going to take off 100 minus the credit factor, minus the volatility factor, minus the liquidation factor. Liquidation factor is really just us evaluating the level of difficulty and what risks are involved in liquidating that collateral, if, like Kylie said, if it ever comes down to that.
Right.
So we started the 100 and take off for each of those different groups. That's how we get down to our lending value percent.
Yep. And then we also have to abide by our regulator. We have regulators too. Sometimes I would trade with you if I could, but we have to abide by our regulatory requirements and advisory bulletins that we have. That includes the delinquency standards that we have, loan classifications, the appraisal requirements, LTVs, DSCR, all of that stuff listed there came directly from our regulator, their guidance, and what they have published and told us that we can and cannot accept.
What we
for
have to
eligibility.
adhere to. Mm-hmm. Mm-hmm. All right, so you're asking yourself, well, where can I find all of this information, right? Right. We make it very, very easy to get to this information. We have it in multiple places. You can log into, just our main public site. It's under products and then the member product services guide. You can also find it under the collateral tab option, QCD form, and then there's a link to the schedule of eligible collateral. And even while you're in the QCD form, we have hovers over each of the different asset categories that will go into detail about those underwriting guidelines. We also have it listed if you go into the resources on our members only portal and look for the member products and services guide. Once you get there, you can tell on screen, the collateral guidelines start on page 68 with the meat of all of it starting on page 80. That's where it gets into the nitty gritty. Okay. So the different asset categories, so if you're going through, if you're picturing your QCD form, for those that fill it out online, it's the unrestricted tab, right? So all of your securities are listed there. Most liquid, easiest to pledge and release. We have single-family real estate loans. We have the FHA VA held for sale. If you're pledging less than 15% of your total assets, you can pledge your held for sale loans on your QCD form. If you are pledging more than, or want to pledge more than 15% of your total assets, you'll need to talk to us and we'll set you up on a daily reporting cycle so that you'll get the volatility of the movement every day, okay? Then multifamily, and then our other guaranteed loans, which right now are our PPP loans that we have made eligible as collateral. This is the only category that you do not report as of quarter end. This asset type takes a monthly reporting, a monthly template update, and it goes, your QCD form gets updated with the current UPB and the number of loans that are pledged. That can change throughout the quarter. It doesn't have to be what was on your books as of current, or as of quarter end. Under the restricted category, so in order to pledge restricted category, we ask that you exhaust all of your unrestricted collateral first. That is typically, and this category is typically capped at 25% of your total assets. So once you've exhausted all your 1 to 4s, your multifamily, all of that, then come here, the commercial real estate loans, ag, seconds, HELOCs, construction, we have residential, multifamily, and commercial, but right now, residential is the only thing receiving lending value. And then if your institution is considered to be a CFI collateral, defined as an FDIC-insured institution whose total average assets over the past 3 years is less than $1,239,000,000, you're considered a CFI institution, you can pledge ag operating and equipment loans. If you are not considered a CFI on your QCD form, this area will be grayed out. So there won't be any question whether you are or not.
It's not available.
It is just not available to you. Okay. So the changes to the lending value that was just approved by our board on Friday the 25th, that will go into effect tomorrow, March 31st. We are actually very pleased to report overall that's a very positive change. Lending values, your bang for your buck is better starting tomorrow. So, for example, conventional, the amortizing loans are going from 78 up to 81%. Your interest-only 1 to 4s moving from 72 up to 75%. FHA and VA less than 90 days delinquent are going up 1% from 91 to 92. Greater than 90 days is going up from 87 to 88. Your held for sale loans, if they're eligible to be sold to Fannie, Freddie, or Ginnie, they're going from 91 to 92%. And if they're not eligible to be sold to Fannie and Freddie, Ginnie, they're going from 78 to 81%. And for that small group of institutions that we still have pledging PPP loans, their value is going from 87 to 88%. And again, like Kylie said, this is really more geared to our blanket pledge institutions. Our specific pledge institutions, for the most part, overall general increase, but not quite as well as the blanket.
Mm-hmm.
In the securities category, again, improvement here. The pass-through, agency pass-throughs are going up from 97 to 98%. That's pretty awesome. Agency CMOs going from 96 to 97. Structured bonds from 94 to 96. There are a lot of other minor changes within that security category that we'd probably spend the hour going over all of those. So please refer to the Member Products and Services Guide if you want more details.
Mm-hmm.
Cash, no change there. We give 100%. Can't get any better than that.
We'll keep giving you 100%.
Right, right. All right. So in the other real estate related categories, ag is taking a big jump from 61 up to 66. Seconds are going from 68 to 71. Your HELOCs from 68 to 71. And the residential construction mortgages are taking a nice jump from 63 to 66. Your CFI Collateral, again, those are for those CFI institutions. Operating loans are taking a good jump from 53 to 57. Equipment loans, 48 to 54. And your student loans are going to drop it's a nice drop. They're dropping from 82 to 76, but
Yeah.
really that overall.
I think overall, student loans, at least from what we discussed today, is the only one that went down.
Yeah. So the impact, based upon our collateral that was pledged on December 31st, you can see overall we're going up 3%. Our members are getting 3% more in collateral on average.
Mm-hmm.
So more bang for your buck. It's good news. We're happy that finally we get to share that.
Yeah. Other recently approved changes that we did increase our individual loan limits. So for those of you who don't report on the QCD form and report on delivery, we do max out an individual loan. And previously it was at $75 million for multifamily and commercial real estate. That will be increasing effective March 31, tomorrow, to $200 million. And so for those members who have been reaching that cap, it will be a nice bump for them to go up to that $200 million. Another eligibility guideline change that I'm hoping you all are very excited to hear is a documentation change that we had, and that is our requirements for loan modifications. We are effective starting tomorrow, allowing modifications, extensions, and renewals to have electronic signatures, provided that they comply with our electronic loan modification or requirements for copies of loan modifications. So that signature on a modification, not a promissory note. And we'll talk about promissory notes here in just a couple of minutes. But for a promissory note, it still needs to retain that original wet signature. However, if you elect to modify that promissory note and you do that through an electronic means, meaning you have a digital signature on some sort of tablet, or you did a DocuSign where they typed in their name. I've done those documents myself. Those will be allowed, and we'll go over the caveats for those in just a moment. Additionally, if you previously had them sign it with a wet signature and you scan that, it's now an image or a copy, we are now allowing that also. So that is a very different take than what we've had before. We've pushed our legal team pretty hard the last couple of years, given how, COVID has sort of changed the world, honestly. And so we really pushed them to take another look at it. And so they were able to come to the conclusion that a modification that would include an extension or renewal can be an electronic signature, meaning it can be signed electronically or it can be a copy of a previously wet signed document. A few requirements on that. If you could go back, I'm sorry.
I'm sorry.
That's okay. A few requirements. You must maintain the original wedding paper note. It has to be an amendment to the paper note and not a restatement that replaces it. So if you're just doing a refinance and that old note goes away, all the terms of that goes away, and that note can stand on its own, that's not a modification, right? That's a brand new note.
Right.
So that gets a little tricky, but keep that in mind. It should not be a restatement of that replaces that paper note. If the mortgage is also required to be amended, it must also be done and recorded. And it must be maintained in a format that's accessible to us. Typically, this means it's stored with your image documentation, or that if we come in to perform a collateral verification, you're able to retrieve that document and show it to us being signed. Okay, the other requirements, and this is specific to electronic signature, they must comply with e-sign and UETA. Those are the guidelines for just legally accepting an electronic signature. If you needed to complete a modification to the mortgage or deed of trust, e-notarization or remote online notarization, also known as RON, will be accepted if it is allowed within the state and that your county recording office also accepts it. It will be up to you to know if that is something that is acceptable and that it complies with such laws. This one's a big one. Electronic signature must occur on or prior to the effective date of the change in the modification. So if we come out to perform a collateral verification and your modification's not signed, you cannot go off and send off for that electronic signature that day. It needed to be done at the time that the modification was created.
When
that makes sense, right? There's
date.
no backdating of
Right.
an electronic signature, is the way that I've been explaining it. The borrower must provide affirmative consent. That is a legal requirement that they have to give consent that they are accepting, that they are allowing you to accept their electronic signature. And usually that's just written into the document in some way. And we will not accept any modifications that are executed by biometric means or audio-video recording. So no finger scanning, no fingerprints, no eyeball retina scanning, no breathing into something. I don't know all the biometric means, but we will not accept those. This is effective for 3/31/2022. However, it is grandfathering in any loan modifications that were executed before March 31 that meet these requirements, right? So they have to meet the requirements, but if they've met all the requirements and you have loans like this that were on your books that maybe you were removing previously, you can add them now.
And put them on your 331 QCD form.
Yep. Yes.
Okay. So underwriting guidelines for securities, we're just going to hit securities high level. No interest only or principal only securities whose cash flows come from underlying collateral. So, for example, the CMOs. We have to be able to price it through our normal pricing vendors. Some instances on the PLMBS, the private placement, we're going to ask for a prospectus so we can determine whether it's eligible or not. Securities underlying loan collateral cannot violate our anti-predatory lending policy. We do upload ratings once a week on all those that have a rating requirement. Our ratings that we accept are from Moody's, S&P, and Fitch. Any private residential or private issue residential mortgage-backed pass-throughs and CMOs cannot be secured property subject to private transfer covenants that were created on or after February 8th of 2011. They have to comply with the interagency guidance on non-traditional mortgage products, risks, and addendums to credit risk management guidance for home equity lending. That's a mouthful. If issued or acquired after July 10th of 2007. And rating requirements are AA or better.
Mm-hmm.
Okay. All right, Kylie.
Okay.
Hit the ground running, girl.
Okay, so there are some commonalities between all asset categories that we have, and they are highlighted here. You will see this requirement in every asset category that we have, right? I'm going to walk through each of these individually, and then we'll walk through the specific asset categories and some sort of nuanced eligibility for those specific categories for you to watch out for, okay? So we're going to start with wet signature.
Okay.
Okay, so wet signature has probably for the last 3 or 4 years been the biggest topic of discussion. Certainly in 2020, it became a lot more prevalent given the environment that we were all thrust into, right? Ultimately, where we have landed is that we can accept an e-note. And an e-note identifies here, an e-note is a note that's executed electronically, stored in an e-vault that meets the requirements for an e-note, which we have published on our website, right? So defining what an e-note is and what it is not. An e-note is not a scanned image of a wet ink signature or a note with an electronic signature that is not stored in an e-vault and does not meet our e-note requirements. We just talked a lot about modifications.
Right.
And the acceptance of electronic signature and a copy of a modification. However, the requirement remains for promissory notes that you must have an original wet signature or it's generated as a true e-note. And if you have questions about e-notes in particular, or if you want to talk about those, if you think you might be generating them or originating them, certainly reach out. We have accepted an e-note into our e-vault and provided lending value for it. And that was a huge step for us.
We were very excited. We did that this month, in March.
Yeah.
So a historical moment for all of us.
Right. So I can't emphasize enough wet signature on a promissory note.
Okay.
Okay. Next, fully secured. What do we mean by that? One, a loan in which the fair market value of the asset or assets pledged as security exceeds the outstanding principal balance of the loan. So fully secured means you've got enough value to cover the balance, right? So that means for single family, the loan to value requirement, single family is 100%. For multifamily, commercial, and agricultural real estate, that is 85%. Additionally, for appraisal requirements, loans that are greater than 250, and that did bump up after 2018. So if you have loans that were before 2018, the requirement was 250. Any loans that are greater than 250. And then after April 9th, 2018, any loans that are greater than 500,000, we have appraisal requirements, which means it needs to be completed by a third party or a certified appraiser. Okay. It also means, fully secured also means that the mortgage amount, mortgage/deed of trust, depending on your state, amount must equal or exceed the outstanding principal amount. So Elaine comes in, she gets a loan for $100,000. I give her a loan for $100,000. I file a mortgage for $100,000. 6 months later, she forgot or she needed to borrow for something else. She comes in and she gets another $20,000. I do a modification with that electronic signature, and she now has a loan for $120,000. If I did not modify my mortgage up to $120,000, I am not fully secured. I'm not saying that's legally. I'm saying that it's in the eyes of the collateral eligibility guidelines, it would not be identified as fully secured. You would need to also modify that mortgage or issue another supporting mortgage to cover that $20,000 difference, right? The one caveat to that is there are future advance deeds of trust in Nebraska that we are allowed that have no limit, right? They're essentially called unlimited advance deeds of trust is what they're called. Okay. We will allow, because they don't define that amount, that future amount, we will allow that. However, in the time frame where you issue the new funds, you would need to get a title search to prove that there was no other lien holder outstanding at that time.
In front of you. Yeah.
Right. If there is a lien holder, then it would cap at where it was when that lien was issued. If there is no other lien holder, then you can move ahead. Okay. Right. Additionally, located in the United States, all of our underlying collateral is required to be physically in the United States, whether that's real estate or equipment, whatever, it has to be in the United States. We have term limitations, unless specifically stated, which we'll talk about in a couple of categories. The term limitation for all assets is 360 months, so 30 years is the limit.
Okay.
Wholly owned always comes up. There are a few different ways to interpret this. Ours is that if it's originated by your institution, so Elaine created this asset.
Elaine's bank.
And she owns it 100%, that's wholly owned, right? If Kylie's bank, originated the institution, but Elaine's bank purchased it,
All of it.
100%, she now wholly owns it. Both are eligible. If Elaine's bank originated the institution, she owns less than 100%, but she's still the originating bank, the portion that she owns, that she retained, so that amount that she retained in that participation, she can still pledge that.
So with $100,000 loan, I sold off $25,000 of that to Kylie's bank. I can still pledge $75,000.
Because that part of it, you still wholly owned, because you were the originating institution. So you hold that note, you hold the control, all of that, right? The last one that we have is if you are the purchasing institution of a purchase participation, we can allow that as a non-lead lender participation with special approval. There's some agreements that you have to sign, there's some checks that we have to do, you get a reduction in your lending value, but if you, and I think we go into it, maybe it's here, but it is a possibility if you have purchased participations less than 100% for you to pledge
So
them.
Kylie could potentially pledge her $25,000 that she bought from me.
Yes,
Okay.
with some additional
Agreements and steps we have to go through. Okay.
no lease loans. A financing transaction in the form of a lease, structured financing is not eligible for us. And also no land development or vacant land. Ag real estate is fine. If it's actively being worked as ag real estate, this is no lots, no subdivisions. If you've got a 10-acre property that you are waiting until prices come down like the rest of us to build a house on. If it's zoned agricultural but it's not being worked, that doesn't really fit. It's really vacant land. It's really if you are producing on that property. So this isn't your 3-acre lot that's just kind of hanging out.
You could put a cow on your 10 acres.
You could.
It's actively being worked.
Yep.
Okay.
Okay. No loans with PACE lanes. PACE lanes. PACE lanes are really tied to energy retrofit programs. The issue that we have with it, one is regulatory, that we can't accept them, but also that they take your priority for your lien. So essentially what a PACE lien is I went in and let's say solar panels, right, or something like that. Typically it's done through your state, locality, municipality, those types of things, where they have an energy program where they want you to make energy efficient improvements to your home. And what they do is they tie that into your taxes in some way. What happens though in some states, some counties, some municipalities, it depends on, at what level that program exists. Sometimes that takes first lien priority. And so we have as a system, Federal Home Loan Bank system, have created we have a relationship with a vendor that identifies PACE across the United States. They let us know if a zip code essentially has a PACE program, and if it does have a PACE program, then we would just check it during a collateral verification to ensure that that property does not have a PACE lien on it. Where we found it has been when you pull up like their tax record. It will show that they have a tax or a PACE lien. Additionally, no loans subject to private transfer fees, and Elaine talked about that a little bit during the securities, but essentially what that means is that there are fees assessed to the seller when the property changes ownership, right? So Elaine's the builder. I go and buy her house, I pay her a fee. That's totally normal and fine. Right. But the way that she set up the transactions in the future benefit her if she has private transfer fees set up.
Might as well.
And what that means is when Kylie sells that to Joe.
Oh, I get a portion of that too.
Elaine gets a fee. And then when Joe sells it to Susan,
Oh, I get it again.
Elaine gets a fee. And so there is a private transfer fee that Elaine is recouping
For the life of the house. every
in
time it changes.
perpetuity, right? We rarely find this, but when we do, we found it in the title work and the settlement statement. And so, you know, sometimes it seems crazy that we're asking for so much information, but that is the reason that we're asking for the documentation, is to check and see, right? So on a purchase transaction, we say, hey, let me see that settlement statement. We're looking at the seller's cost to see if there was a fee that could be identified as a private transfer fee. No director, officer, or employee loans of your institution or FHLBank. I know these are probably some of your best loans on your books, and I hear it all the time, and I'm so sorry, but per regulation, we just can't take them.
Mm-hmm.
So if you've identified it as a director, officer, or employee loan, your Reg O, however it is that you identify those insider loans, they should not be pledged to us. Additionally,
If I go to your bank and borrow money, you cannot pledge my loan, unfortunately, because I'm a Federal Home Loan Bank employee.
right. So most of the time, we don't see that unless you're maybe local to a Federal Home Loan Bank.
Topeka area, yeah.
But yes, every now and again, we have seen it. Past due, no loans past due. For single family, we consider past due greater than 90 days, and all other assets 60 days. Now, of course, FHA and VA have their own sort of, because they're government guaranteed, they can go past that. But for single family and then all other assets, they are capped at those days. And then not classified, substandard, doubtful loss, non-accrual. It can be on watch, so we will go up to watch, but once it goes over to that threshold of substandard or moves to non-accrual, then it is no longer eligible.
Okay.
It cannot be pledged to another creditor or in another asset category, so we don't split. We don't put 50%, oh, the loan has commercial real estate and equipment, I'm gonna put 50% of it over here to equipment and 50% over here in commercial real estate. Essentially what that means is you would put it in the lesser of, so whatever category is receiving the least amount of lending value is where you would pledge that asset, right? But we don't split them. So we don't split them between categories.
100% in both categories.
Right, you can't do both.
No.
Certainly no double dipping.
No, we had that question actually this last week. We did.
Yes, so you can't put it in both categories, you can't split it between the two, and you also cannot pledge it to two entities. So you can't pledge it to the Federal Home Loan Bank and also another entity, like maybe a relationship you have with the Fed or with another lender agreement. This is new for us. I think as of 12/31, no adjustable interest rate LIBOR index loans with a note date after December 31, 2021. So we know that LIBOR is ending June 23, right?
Yep, June next year.
So we know that LIBOR is ending. We need you to start preparing for that. So that means stop using LIBOR for new stuff.
Right.
So anything that's issued after December 31, 2021 that has LIBOR as an index will not be eligible. And if it continues to have US dollar LIBOR tenors of 1 week or 2 months, it is also not eligible. They no longer publish those rates.
Right. Those ended as of the end of the year.
Right. And so if it's still tied to that and that doesn't exist,
how are you adjusting your rates?
Right, then it's not eligible. Additionally, servicing or custodial agreements must be on file if applicable. If you have a third-party servicer or custodian, we would want to take a look at those agreements.
All right.
Okay.
Now
So
let's
now,
go into the nuances of each of the asset categories.
yeah. So now we're going to go through the actual individual categories. So single family, 1 to 4 family, first lien position. If it's in second lien position, it goes in the second mortgage category. Fully dispersed means there's no revolving lines of credit. It has to be completely dispersed. No subprime characteristics. We have a 2-part test. We have FICO. The first test is if the FICO score is less than 660 and the debt to income is greater than 50%. That's test 1. So if you have a 560 credit score and your debt to income is 26, you're fine. If you have a 665 credit score and your debt to income is 55, you're fine because one mitigates the other. The second, though, if you had a 560 credit score and a debt to income of 55%, that would be considered subprime characteristics. If someone would define subprime, that would help us out a lot, but they don't. And so the characteristics are that there's no mitigating factor there. The second test is that if the FICO score is less than 620 and the debt to income is greater than 55%, again, this is an or test, so 620 or 55%, we would need to understand why you continued to write that loan. What credit decision went into that? So you can do it. Nobody's saying you can't. We're not saying it's a good or bad loan, but what mitigating factor did you use to compensate for those lower triggers, right?
Right.
Additionally, no non-traditional characteristics. So in income and employment verification, hopefully you're obtaining those as you're generating new collateral or new loans. And then no simultaneous seconds. We don't accept simultaneous seconds that go over 100%. You can do an 80-20, you just can't go over. Some of these problems came directly after the 2008-2009 crisis, and they still linger today. But they're still impactful and they're still important,
Absolutely.
right? And adjustable rate loans, you want to make sure that borrower qualified using the fully indexed rate, not just on like some super low teaser rate, because I think, again, in 2009, that's what kind of got us into that big mess.
Yes. Don't want to do there again.
Right. No predatory characteristics. The 4 that we're looking for are if you require mandatory arbitration, if you have high fees and rates, or if it violates HOEPA, we're checking for that. Prepayment penalties beyond the early years. Early years are considered 3 to 5 years. You can have early prepayment penalties, but if you've got life of loan prepayment penalties, that's a problem. And then if you have single premium credit, life, and disability, that would be identified as a predatory characteristic. We don't allow for reverse mortgages, and one-time closed construction of permanent financing loans are eligible. This happened in the last couple of years, I'd say.
Relatively new.
The term to maturity, which is at 360 months, would begin with that conversion date. So with the construction, it might be past that 360 months, but we would look at the conversion date and go to maturity for the 360. The only difference on our interest only is that there is a minimum FICO of 680. So all that subprime, less than this, greater than that, mitigating factors, you must have a FICO score of 680. Okay.
No.
FHA or VA loans must comply with the agency's underwriting guidelines. The certificate or guarantee must be present, and it can be 90 days past due. The lending value is then based on the guaranteed portion, and there is special entry on the QCD form for that amount.
Right. There is a line for that amount.
Yep, and Elaine already went over our held for sale, but we do have agency eligible, non-agency eligible, and depending on the amount that you pledge, you could report them on the QCD form, or we may require daily reporting.
15% of total assets or more. All right, down to multifamily.
Multifamily, and I know I'm talking really fast, but there's so much stuff I want to tell you guys. So, multifamily, 5 or more units. So this is the actual structure has 5 or more units in it. This is not 3 duplexes, right? Because the duplex is a 2-unit structure, and if you had 3 of them, that's 6, right? Those would be considered 1 to 4 family, because the structure itself has 2 units.
Gotcha.
Right? So the 5 or more units for multifamily is the actual structure has 5 units. Okay? We find that all the time.
Right.
During our
Right.
reviews.
Well, it gets confusing.
Yeah.
Right.
It is confusing, especially if you deeded them all together. If they've all been appraised together, then it might be considered multifamily. For us, it's the actual structure, the actual collateral.
Okay.
The interest-only period is 7 years or less, so we do allow for interest only. The maximum loan-to-value is 85%, and we do require a debt service coverage ratio of greater than 1.
Greater or equal to.
Or equal to 1, yes. We talked a little bit about appraisals earlier. Appraisals after April 9th, 2018 must be prepared by a licensed or certified appraiser. with an amount greater than $500,000. Commercial real estate, also interest only available, 7 years or less. LTV is the same at 85%. DSCR greater than or equal to 1. Phase 1 requirements, we do require for commercial real estate loans where the collateral exhibits adverse environmental factors. I've been asked so many times over the last 10 years of my career to define what that is, and I cannot define it. It's, many of you play soccer, like, I can't tell you what offsides is, but I can tell you when I see it. That's a Ted Lasso reference for all of you, but the phase 1 requirement is really if you've got a property where you have to properly dispose of a material.
So maybe a Jiffy Lube with disposal of the oil, or
of course a gas station, right? You want to make sure that there's no leaks, that there's nothing going on in the underground storage tanks, you know, those types of things. So if there is a potential for an environmental hazard, we would want to see a clean phase 1.
And
Okay?
clean phase 1 is
Clean
the
phase 1.
yes.
Vacant land development, we've already talked about that this is not, you know, they've popped in curbs and sewers in that subdivision. There actually has to be a structure there, and it would have to be a commercial real estate structure to fall under commercial real estate, right? No leasehold estates. Leasehold is not eligible in commercial real estate, and it cannot be secured by a property used for marijuana-related business. We know that we have some states in our 4-state district, Colorado and Oklahoma specifically, where marijuana-related business is legal. Marijuana is legal. However, federally, it is not legal yet. And because we cover the entire United States for eligible collateral, it is something that remains ineligible for us. Okay, and then the same appraisal requirements as multifamily. Ag real estate, maximum loan to value of 85%. We do allow interest only here, but it is capped at 18 months. If you go up to 18 months, we would require to see a financial statement if it is interest only. No vacant land, again, it must be used for agricultural purposes, no leasehold, again, that marijuana, and no loans with a guarantee from the FSA. FSA guaranteed loans are not eligible. So even the portion that is not guaranteed is not eligible to be pledged if it has an FSA guarantee on it.
It has to do with the liquidation of that collateral, if we should ever have to do that.
It gets really messy.
It gets really messy, and we're just not eligible to be in that position. So.
Right, exactly. Second mortgages, these are the second lien position, very, very similar to 1 to 4 family. Must be fully dispersed, no subprime, non-traditional predatory, which we went over earlier. No negative amortization is allowed, and the maximum combined loan to value is 100%. And what that means is we want to know what that first mortgage balance is, plus what the second mortgage balance is, and make sure that it doesn't go over 100%. HELOCs are very, very similar. However, they can be first or second lien position. It can be first lien because it doesn't go in the 1 to 4 family, right? Because it's revolving. So revolving lines of credit are acceptable. The maximum combined loan to value is 100%. However, with a HELOC, very different. To calculate that, we use the full line amount, not the amount that's advanced. Because at any point, they could go up to that full line.
So if I am approved to go up to 50,000 and I only have 25 outstanding, you're still going to use the 50,000?
Yes,
Okay.
to approve the 100%.
Okay.
Okay, residential constructions, no spec loans. So if there is a contract for sale or rent at the end of the construction period, we would accept it. If there is not, and it's a builder loan, then we would not, it would not be eligible. Again, no subprime, non-traditional predatory. That goes with any sort of consumer-based, you and I could go get those loans, right? No negative amortization. Interest only or principal payments are required, so this can't be just like a at maturity, it's due, right? Mm-hmm. There would need to be payments made. One-time construction close is allowed. So that rolls to permanent financing. The initial advance period is limited to 12 months, and the total term on residential construction cannot exceed 18 months. As someone who recently built a house, I was concerned, given the time, that I could not make it in that 18 months, but it happened, and it's okay, right? If for some reason it takes longer than that 18 months, you would just need to remove it. And the loan to value will be based on the proposed value on the appraisal, and we would go up to 100% there. Ag operating, and these are for those CFI folks. So ag operating are secured by crops and or livestock and or in combination with ag real estate. So this would not be an ag real estate loan. It has to have crops and or livestock with it. If it were just ag real estate, it belongs in the ag real estate category, okay, right? If it's interest only, the term is limited to 18 months. Revolving line of credit is allowed, but there cannot be any carryover debt. So if last year's crops didn't pay, you can't carry that over to this year's line, right? Cannot be secured by property or crops to be used for marijuana-related business, again, because it's not federally allowed. Legal, that was the word I was looking for. Thank you, Elaine. And then no FSA guaranteed loans in this category as well. And for equipment, it must be secured by equipment. We don't define what equipment has to be. Typically, it's used for a business or farm, right? So it could be farm equipment, it could be business equipment. We've taken everything from tractors for a farm to a combine to a LASIK machine, right? Because there was an eye doctor, so that was very expensive equipment, right? So we don't say that it has to be farm, but it does have to be used for a business. So no interest only or negative AM loans. It must be fully dispersed, and that's very different than the ag operating. No carryover debt. So again, this is not where maybe your ag operating didn't pay out, and so you just put it over here on this term payout. That would not work. No marijuana related business and no FSA guarantee. So just to kind of recap some of the things to look out for that are different for certain asset categories: the interest-only terms, subprime, predatory, non-traditional characteristics run throughout but are not in every single category. If you have a leasehold, sometimes that's acceptable depending on the type. So single family, multifamily, leasehold is acceptable. Others, it is not. Appraisal requirements, loan to values, phase ones for that commercial real estate. Revolving lines of credit are allowed in some categories, but not all. Across the board, marijuana-related property, crops, or equipment is not allowed. And then the FSA guaranteed loans, if you have any loans that are tied to that, they would not be eligible. Okay. I'm going to take a breath. Oh, we're going to talk about case by case for a second.
You can't breathe yet, girl.
So we just went through all of the requirements, not all of them, right? We went through the highlights. There's so much that's in there, but we went through the big points, right? But we know that not every asset that you create or the types of loans that you create fit within those guidelines.
Right.
And so we do have case-by-case collateral approvals. If you have a niche in your bank that you create a certain type of asset that we just don't accept for one reason or another, reach out to us and we'll see what it is that's causing it to be kicked out, right? Is it a regulatory problem? I can't fix those. Or is it something that, you know, maybe if we reduce the lending value, we could get on board with it, right? So again, mitigate that risk. And so some of that is we need to scale the request. How many loans do you have? What's the dollar amount impacted? How would it affect your overall collateral picture if you were able to pledge those loans? And so we would evaluate each of those case-by-cases individually to see, you know, the acceptability of it, any lending value impacts, and what your collateral needs are. There is a case-by-case review fee of a minimum of $500, and if we had to get legal involved, there would be a fee for their services as well. But I don't want you to think if you have a ton of loans that you're kicking out, there is an avenue to at least ask if they could be eligible.
And if you have a question, you aren't sure whether we would entertain it or not, ask the question. You know, Kylie should be able to tell you, maybe we can do that, or no, there's no way we're going to be able to budge on that.
Right.
We're not going to charge you the $500 for that, right? if we go into, and she says, yes, that's a possibility, let us take a deeper dive look at it. So we're going to be upfront and be as honest as we can about it, so. Goodness, we got some questions coming in?
Yeah, I think it's Q&A time, isn't it?
It is Q&A
Yay,
time.
and we had a couple. One came in and said, can you tell us about the regional and annual meetings? We have a slide for that. As soon as we're done with Q&A, we will get to that, Amy. Thank you for your question. And then one that we had, that your regulator will allow us in certain situations of market valuation up to $1 million. That's typically for ag real estate. Yes, we would allow that. You would simply need to provide to us and show us where it is allowed within that circumstance, and then we would accept that. Okay, Elaine, other questions that have come in?
Oh, yes. Do we allow swap loans as collateral?
Okay, so swaps are kind of tricky, right?
Okay.
And I say they're tricky. We talk about this typically throughout the year, but swap loans get a little tricky because it depends on the way the agreement is structured. Sometimes that agreement is structured on a swap where they have essentially taken priority of that collateral.
Oh.
Right? So if in your swap agreement that vendor, I don't know what else to call them, but if the vendor takes priority on that collateral, then no, you would not be able to pledge it. If they don't, then yes, you could. I've seen it both ways. Typically, I've seen it more where they take priority than not.
Okay.
But I have seen both. So it's not kind of a blanket, no, you can't pledge them. I would tell you to be very cautious if you were pledging them. And if you have them and you want us to look at them before you pledge them, certainly let me know and we can work out a way for us to review them.
Excellent. Here's one. Can we use an environmental report instead of a phase one?
No.
No?
No.
No.
I'm sorry. I'm sorry. An environmental report is not adequate to meet what we need. And the issue with the environmental is that in the event something happened, right, we've talked about this, and we had to liquidate, or in the event something happened and we had to end up holding those assets, we would then be liable for the environmental impact if there was one. And that's just not a risk that we're willing to take on.
How about a DSCR? Does it have a time limit? Do you have to get updated DSCRs at any particular interval?
We do not. For our blanket pledge members, we do not require an updated DSCR. So if you got one at origination and it's been 5 years ago and you haven't updated it, but it's over 1.0, you're good to go. We don't require it to be updated.
How about our specific pledge institutions?
Specific pledge has to be updated every year.
Okay.
Yes.
Good to know.
And if you did update it, we would use the most recent one. So if it was 1.0 at origination and then you updated it a year ago and it was 0.85, we're going to use that. Okay.
Yep. How about appraisals? Do they have to be a certain age? Do you have to get a new one every so often?
Appraisals? Appraisals are fine as long as they were there in origination and they cover the LTV. We don't have a date requirement on those. Now, within reason, right? If you're using a 20-year-old appraisal and you created a new $20 million loan, you have no idea how old that is, right? If you issue new money, the likelihood is you should have gotten a new appraisal. But some of that is very gray, and some of that is just, a judgment call kind of thing. Okay, are loans modified with a scan modification agreement with a wet sign note eligible to pledge? Yes, starting on March 31.
Starting tomorrow.
Starting tomorrow, if you have a wet signed note, but the modification is either signed electronically or previously signed with a pen or imaged, they would be eligible.
Okay.
So the note is what is supporting that, and that is how our legal team got comfortable with that, was that the note remains sort of the governing document. The modification is just supporting. So that's that whole, if it restates, it's not okay. But we also had a couple Will you
Oh.
accept HELOCs without maturity dates? No, we will not. The reason we will not is because we have a term limitation. And without a maturity date, there's no way to really define what the term is. But that's a really good question.
Mm-hmm.
Can you accept fractional ownership on a 1 to 4 family property? Again, the answer is no. Fractional ownership gets really tricky from a liquidation standpoint. And so no, we do not accept fractional ownership.
Well, we are just a minute or two after 3 o'clock. Let's kind of wrap things up.
Yeah.
But if you have other questions, we will provide you our contact information.
And we have a Q&A,
Absolutely.
right? We have a Q&A webinar next Friday.
So accurate reporting of eligible collateral is so important. It determines your borrowing capacity here at the Federal Home Loan Bank. It allows you to maximize liquidity by allowing non-liquid assets to be used as collateral. It helps to improve the results during your collateral verification. Eligible collateral is much easier to validate than ineligible because we're going to try to help find ways to help make that eligible or,
Yep.
or guide you to that direction.
Yep.
It also reduces the expense associated with the collateral verifications. It's the faster that our guys can get in and out, the cheaper it is,
Mm-hmm.
right?
Absolutely.
We do have up and coming educational opportunities. Our annual management conference is, in about 3 weeks, starting on April 20th in Overland Park. We'll have regional meetings this fall through our 4-state area. Dates are below, and more information as the dates get closer. We'll be sending out more information on those.
And the AMC is right around the corner, and if you haven't signed up yet, we really encourage you to do so. They've got some really great speakers this year, and we're excited to always see you in person. This is our first
Absolutely.
one in person since a couple years ago.
2019?
Yeah.
Yeah. And as always, one-on-one collateral guidance. If you have questions, please call, please reach out. We're here to help you be successful. We want you to be successful. Makes us happy. That's our job.
Yep.
Here's our contact information, so please feel free to use it. Again, we're here to help. We appreciate you all taking the time out of your busy schedules to be with us this afternoon. Tomorrow we'll do the collateral verifications on how to have a successful CV. Would love to have you all join us then. We do this whole series again next week at 10 o'clock, so if you feel like you missed something and want to rejoin us, feel free to do so. So thank you again. We hope you all have a wonderful rest of your afternoon.
Okay. Thanks, guys.
Thank you much.
Take care.